Good morning and welcome to CFRA'S webinar, the 2020 Mid-Year Review and Outlook. Benefiting from the BTE, Better Than Expected Outlook. I'm Ken Leon, Director of Equity Research. Our presenters today are Sam Stovall, Chief Investment Strategist, Tina Moby, our Senior Industry Analyst in the Consumer Discretionary Sector, and Todd Rosenbluth, Head of ETF and Mutual Fund Research. A little bit about CFRA and our history of 90 years of innovation and growth as an independent research firm. CFRA today is a dynamic organization offering fundamental and forensic research and has enormous data and analytic capabilities. Back in 2019, acquiring First Bridge Data, and of course, the scaling up of our firm was the October 2016 acquisition of the S&P Equity and Fund Research. Today, we are one of the world's largest independent research firms. Next. CFRA is really an enormous engine for driving value-add, insightful research. You can see here visually kind of the flywheel for our production of research. As you'll hear from Sam, our market commentary, Sam's work with the analysts in terms of sector and industry research, the collaboration not only to offer our insights and recommendation, but regularly today acting in terms of ETF and mutual fund research that Todd will speak to. And then the foundation of our research, both fundamental and forensic, is the deep coverage we have on companies. In the case of fundamental research, covering 1,500 global companies, we additionally have a quantitative platform of 25,000 additional companies to our analyst recommendations. We have proprietary tools and analytics, particularly on the forensic side, that helps us identify what is called biggest concerns. And ultimately, what we are providing in Market Scope Advisor is our insights and thematic research, which is rigorous deep dives into key industry trends, as we'll have with Tuna today. Next slide. Ultimately, we link our capabilities and our research to proven performance. You can see here in May that CFRA ranked #1 compared to firms covering more than 900 stocks, some of the well-known leaders of Wall Street. So CFRA strives to deliver performance to help clients in terms of their portfolios. Next. I always like this slide, and it really drives our value creation, who CFRA is our independence. All the resources, not only research, but every part of CFRA is dedicated to research, and our investments and our innovation are all related to research. We think this distinguishes CFRA because we don't manage money or make trades, and we do not have an asset management arm. So we're a facilitator as a research provider to what you do. Other firms that we compete with say that they're independent, but it's not as much as what we can prove. Next, please. So with that, let's get to today's program, BTE, Better Than Expected Bounce. Sam, good morning.
Good morning, Ken, and good morning, everybody, for tuning in. Yes, I'd like to talk about the better than expected bounce that we have experienced so far, and then pose the question as to where do we go from here. Kessie, let's go to the first slide of mine. Retreat and recovery. What I'm showing on the left-hand side are the sectors, styles, sizes found within the S&P Composite 1500 index, basically the total US index combined with S&P's global 1200 index. And during the most recent market decline from February 19th through March 23rd, every size, style, sector, and sub-industry declined in price, S&P down 34%. What was most amazing about this decline was its swiftness. Basically, I say that the market exhibited the glide path of a crowbar, because from February 19th, only 22 calendar days later, we eclipsed the minus 20% decline threshold, which was twice as fast as we did back in 1987. Then bottoming on March 23rd, 33 calendar days after the peak, we actually bottomed 3 times as fast as 1987. Since then, from March 23rd through June 8th, the S&P 500 surged almost 45%. Not surprisingly, all sizes, styles, sectors, and sub-industries increased in price. And mainly it was because investors were anticipating that we would be experiencing a V-shaped economic recovery, that earnings would start to come back in 2021. And once the economic data started to come out proving that's why we call it the BTE, or better than expected bounce, because the market did bounce when we started getting economic data confirming that we're emerging from this economic collapse. Next slide, please. We also find that going back in time, that whenever we have had a bear market of 40% or less, we were down 34%, the market got back to break even, hit a new all-time high as seen in the bottom thick arrow 14 months later. So implying that by the end of May of 2021, history would indicate that we will be trading at a new all-time high. Yet the market said, gee, well, if this was a man-made bear market and recession, maybe it can be a man-made and therefore swifter economic recovery and stock market resurgence. So maybe we'll be like 1966, 1982, 1990, in which we got back to a new all-time high in 7 months, 3 months, 4 months, challenging these fewer than 10-month performances. So I think that's what investors had been looking forward to. Let's take a look at the next slide, where we are right now. Well, obviously, we've got headwinds and we've got tailwinds. The headwinds are the ramp up that we are experiencing now in the COVID-19 cases. Those states that opened fairly quickly, now they're second guessing themselves as to whether they opened too quickly. We're now in the beginning of the second quarter earnings reporting period. Market is expected to post a 45% decline year on year in operating results. Every sector is expected to post a decline in earnings, and 90% of the 125 sub-industries in the S&P 500 are expected to post negative earnings for this second quarter. Democratic sweep of the executive and legislative branches. Investors are worried that the president will be a one-term president, and Wall Street does not like uncertainty. It does not like wondering about what could happen with the new administration and whether we will see the House and the Senate be firmly in the other camp, being dragged in by the coattails of the president. Tailwinds, however, remain in force, that being large and swift fiscal and monetary stimulus, the continued expectations for a V-shaped economic recovery. Action Economics is forecasting a 26% surge in annualized GDP in the third quarter, followed by a near 9% gain in the fourth quarter and a more than 6% advance in all of 2021. Wall Street is also looking across the valley, sort of sounding like the Brooklyn Dodgers fan of old, saying, wait till next year, in which we're looking for a 30% advance in earnings for the S&P 500, 50% advance for the mid-cap, 150% gain for small caps, and also globally seeing a 50% rise for developed international and 30% for emerging markets. I will focus just before turning over to Tuna Amobi, investment strategy following very sharp market declines, titled Worst to First. But Kessie, let's go to the next slide. Again, looking across the valley, this is what I had mentioned, where the blue bar is 2019 actuals, gray bar is the 2020 estimates, orange bars are 2021 forecasts, and we're seeing an expectation for a very strong jump in operating profits for these global indices, the S&P 500, S&P's developed markets, emerging markets, etc. So giving optimism that that is what is likely to be pushing this market, or at least having pushed the market over the past month or so. But with the next slide, we can actually see that, well, we're in sort of a challenging period for the market. Typically, we end up seeing the worst average price performance in the third quarter. The blue bar shows the average price change for the S&P 500 since World War II. The orange bar shows the average small cap Russell 2000 index performance since its inception in 1979. And we see that in the third quarter, that S&P 500 growth is 0.5%, as compared with anywhere from 2 to nearly 4% for the other quarters, whereas small cap stocks are actually typically in the red for this third quarter. What else could be causing a problem? Kessie, let's take a look at the next slide, is that we are swimming in a sea of red ink. That down almost 46% is was the forecast as of June 30th for the S&P 500. Small caps down almost 72% in earnings. Mid caps down almost 72%. Small caps actually dipping into a loss rather than simply a very sharp decline in profits. But the good thing is that we are looking at a potential nadir for this earnings recession. Third quarter will be negative, but not as much. Fourth quarter will also be negative, but we're going to be seeing three sectors peek their head above the water. And then as we move into 2021, for the full year, expectations are every sector in positive territory, with the market itself up 30, 50, nearly 150%, whether you look to large, mid, or small cap indices. But still, in this third quarter, challenges await. Let's take a look at the next slide. What can politics do for us or to us? The Presidential Predictor basically says that from July 31st of the election year to October 31st of the election year, as we see in the far right-hand column, if the market has declined in price, the incumbent has been replaced every time but one. Only in 1956 did that not happen. But basically what it implies is that if we have a negative result for the market, it's an indication that investors are concerned. They're concerned that there will be a change of horse in midstream, that there will be the likelihood of uncertainty as to what the new administration is going to bring in terms of taxes, in terms of regulations, etc. And right now, I think investors are worried about a triple play, the possibility of a Democratic presidency combined with a Democratic majority in both the House and the Senate. Well, what does history have to say we have to look forward to? Kessie, let's take a look at the next slide. And what we find is that that's happened 5 times since World War II, that we have had a trifecta, if you will, the executive and both houses of the legislative branches be Democratic. 1948, 60, 76, 92, 08. In November, because the surprise of the sweep took investors, causing the market to decline nearly 2.5%, falling in 3 of 5 observations. Yet the seasonal optimism took over once again in December, which is traditionally the most optimistic month, the month in which the market rises in price most frequently, did what it normally does, gained in price in every single observation, rising more than 3% on average. And in the year ahead, the full calendar year ahead, the market was up 80% of the time and posted an average price increase of nearly 10.5%. So once Wall Street knows what it has to deal with, it then deals with it and doesn't worry too much about it. It's usually the surprise that causes the market to go down in that election month, but then recover itself as we proceed forward. Let's take a look at another slide saying, what about other situations in which we have a Democratic presidency, et cetera? Well, these are different political scenarios going back to World War II. A unified government means that the executive and both houses of Congress are of the same party. Unified Congress says, well, you have maybe a Democratic president, but a Republican Congress, or vice versa. And then a split Congress simply means that one house can stymie the other house in terms of not approving legislation, et cetera. What we find is that a Democratic president, that's happened 22 times since World War II, average price change was a gain of 9.8%, not as good as under a Republican president, but its batting average, its frequency of advance, FOA, was 77%, which was best of all political scenarios. So history basically says maybe we shouldn't worry too much about a Democratic administration. And if you wanted to attempt to time adding to your portfolio, maybe you would do so in the latter part of November of this year. Let's take a look at the next slide. What does the market tell us? Once we go through a very sharp decline in prices, where are the investment opportunities? Well, this shows declines anywhere from 19.4% up to almost 57%. So bear markets and near bear markets since 1990. In each one of these cases, 6 months after that bear market or near bear market low, the market was up, and it was up an average of a little more than 30%. Well, if you had actually purchased the 3 worst performing sectors during the market decline and then held them through the next 6-month period, you actually would have beaten the market in every single observation with a gain on average of a little more than 42%. Sub-industries, meaning if you bought in equal amounts the 10 worst performing sub-industries during the market decline, you bought them at the bottom of the market decline and held them for 6 months, the average price increase would be more than 60%. Why am I telling you this? Because let's go to the next slide. We can see who were the worst performers in terms of sectors and sub-industries. Energy, financials, industrials were the worst performers from February 9th and from the 23rd of March through the end of it. While the S&P was up a little less than 39%, the 3 worst sectors were up almost 44%. And if you look to the 10 worst performing sub-industries, 5 of which were in the energy sector, not surprisingly, but 4, shaded in blue, were from the consumer discretionary group. Department stores, hotels, resorts, cruise lines, household appliances, motorcycle manufacturers. But if you look to the average of these 10 worst performing sub-industries, their gain was 55%, which then gives me the opportunity to turn the presentation over to Tuna Amobi, with the question being, will consumer discretionary stocks, sub-industries, and the sector continue to do well in the period ahead?
Great. Thank you so much, Sam, and good morning, all. We are so thrilled that you can join us today. So as Sam alluded to, the next section of this presentation, we're going to look at some really critical industries that have been at the cross currents of this COVID-19, specifically the tourism, leisure, hospitality, and restaurant industries. I think this is couldn't come at a better time as we do this half-year review, because as we kind of look toward the recovery from this pandemic, I think it's fair to say that the industries that we're going to highlight and talk about here have been the hardest hit thus far. And looking ahead, it's impossible to talk about a recovery without keeping an eye on these industries and see how they fare as we go along. So next slide, Cassie, please. Today, we'll cover some topics here. In this section, we'll look at the COVID-19 performance, the backdrop, and then we'll kind of assess the impact on global travel and tourism, look at some of the secular and macro factors that influence the outlook in this space and the trends, and then some of the key indicators and industry for industry recovery and some of the key metrics that we use to kind of size up the outlook and trends for some of these industries. And then finally, we'll kind of review some of our sample stock ratings. Next slide, please. So we kind of wanted to lead off with this slide that gives a pretty, wide view of the global spread and historical perspective of the COVID-19 pandemic. As you see on the chart on the left, the number of cases now globally for COVID-19 has exceeded 11.5 million, with a mortality rate that's also rising. And those numbers, by the way, are rising and spiking pretty fast as we speak. Now, what's the significance here? The significance is that COVID-19 has dwarfed other prior outbreaks of major infectious diseases, as you see the chart on the right. Compared to either SARS or Ebola or MERS, this is a pandemic of unprecedented proportions, which inevitably has led to a seismic disruption of the global travel and tourism space, the hospitality, leisure, restaurants. All of these industries have never seen anything, of this magnitude. And in fact, the impact of the Great Recession, pales significantly in comparison to what a lot of these industries are currently navigating. And the global perspective is also particularly significant for this group because a lot of these companies have international operations. They have significant exposure and footprint. Overseas, they rely a lot on international visitation and global cross-border travel, things of that nature. And I think that's why this pandemic has been extremely disruptive for a lot of these names. Next slide, please. So here we kind of look at the equity index performance for the industries that fall within this space that we're talking about. As you look at the chart here, it's pretty clear that all of the sub-industries, restaurants, hotel, resorts, and cruise lines, as well as the casinos and gaming, have been extremely volatile compared to the broader market S&P 1500 index. It's quite interesting because as you last year, both the casinos and gaming and hotel, resorts, and cruise lines significantly outperformed the broader market. This year, we see them lagging significantly relative to the S&P broader market composite. Now, you look at the restaurants, that performance has been a little bit, more closely correlated to the broader market index, but even then, they're still lagging a little bit this year. And you see the onset of the COVID-19 in late March and early April as those pandemic took hold. You see the major drop in a lot of these indices, which has been quite dramatic. On the right side of the chart, our sub-industry outlook: neutral on restaurants, casinos and gaming negative, hotel, resorts, and cruise lines negative. So again, those three sub-industries, based on our GICS classification, global industry classification, are really what encapsulates a lot of the companies and industries that we'll be talking about today, and kind of looking at the impact of COVID-19. Moving on to the next slide. This is a chart that kind of gives you, a perspective on what the impact of COVID-19 on global travel and tourism could be for this 2020 expectations. This is actually an outlook put together by the World Travel and Tourism Council that was just published a couple of weeks ago. This actually looks at some of the travel, the leading and lagging indicators that could influence the outlook, both from a baseline, worst case, and best case scenario. So things like impact on travel and tourism GDP, global visitor arrivals, and also jobs, the number of job losses. In all these metrics, I want to focus on the baseline scenario for a second. Now, even the baseline scenario calls for pretty steep declines year to year, and these are numbers compared to 2019. I think one takeaway here is that in the last couple of weeks since this was published, our takeaway is that even the baseline scenario could be a little bit optimistic now, because we've seen some major flare-ups of COVID-19 across some of the states that threatens to delay or impede the recovery outlook. So we would take this with a little bit of caution. look at the best case scenario, still calling for significant declines in tourism, GDP, visitor arrivals, both international and domestic, as well as the number of job losses. So this is just something to underscore the major dramatic impact of COVID-19 that's expected to occur across the global travel and tourism industry. And we think that given some of the flare-ups and some of the walkbacks of some of the reopenings across some of the states that we've seen as the number of COVID-19 cases continue to flare up, there is in fact a chance that the V-shaped recovery that we might have expected from the baseline scenario to the best case scenario could actually be potentially derailed. Because I think there's a prospect of V-shaped recovery from our perspective based on the the amount of disruption that we expect this year and the snapback that we expect as some of the travel restrictions may be eased. And one of the parameters, one of the potential swing factors here is the timeline for the easing of the travel restrictions. In the baseline, calling for these restrictions to be eased domestically in June, and then also July to September for both short haul and international intercontinental travel. As we know, some of those timelines are likely to be shifted if this flare-up continues. So that's the one swing factor to keep in mind as you think about the recovery outlook for this space. Next slide, please. Here's where we show the travel spending and inbound visitation for travel spending in the US. I think you see here that total travel spending in the US is set to plunge alongside inbound visitation in 2020, no thanks to COVID-19, as shown on the chart on the left. Notice the spiral downwards in travel spending projected for 2020, down 45%, expected to rebound 37% 2021, both domestically and internationally, and moving on from there. Again, this is all dependent on things getting the travel restrictions starting to ease in the next few months. And right now, there's still uncertainties around that. On the right chart, you'll see the international visitors to the US. Again, a very important metric as you think about the spending. The year-over-year change projected for 2020 down 29%, snapping back next year and continuing thereafter. So you see that these are all important parameters that you think about what impact COVID-19 could have on this travel, tourism, leisure, and restaurant hospitality. So this is a very important metric to keep an eye on. But these are the current projections right now. Next slide, please. Now, here we'll talk about air and road passenger traffic, right? So air travel in terms of passenger screenings based on TSA numbers is a pretty good indicator of the consumer sentiment and willingness to travel. And right now it looks to us, based on the chart on the left, that even as US air passenger traffic has shown some signs of picking up lately, since last few weeks, you can see the chart is still sharply off versus prior year, almost 80%. So we are nowhere near getting to the level of traffic that we had pre-pandemic for air travel, and that's a very important indicator as you think about a lot of these names and how the road to recovery might shape out. And it's pretty clear it's going to be a long road to recovery based on this travel indicator. On the right chart, you see the road travel index, which suggests that based on recent readings, recent weekly readings that were pretty close to approaching pre-pandemic levels, which is really no surprise because a number of surveys have shown that folks are generally more comfortable traveling in their own cars as opposed to air travel or otherwise. So road travel has been faster to recover, which might bode well for businesses that maybe rely on closer destinations or short travel trips, things of that nature. But when it comes to the majority of hotels and businesses that are reliant on air travel, cruise ships in some respects, These are all things to keep an eye on to assess the sentiment around travel and how that might impact the road to recovery. Next slide, please. So here we're showing the leisure and hospitality and the impact of remote workforce by business sectors. This is pretty interesting here, because notice that the leisure and hospitality sector or industry, which by the way, these are government industry classifications based on Bureau of Labor Statistics. The leisure and hospitality classification for this purpose includes the restaurants, the hotels, leisures, the casinos, and everything else we're talking about today, and some more. But the thing here is that leisure and hospitality industries mostly require their workforce on site, whereas the white collar occupations are more likely to work from home during COVID-19. So notice that financial activities and professional and business services, those tend to skew more, they tend to be more amenable to remote workforce, which I assume most of the people on this call can relate to. On the other hand, leisure and hospitality has been hit hard, and if you're asking or looking for a reason why this space has been particularly hit so hard, it is because the jobs in there are less amenable to telework, and that's pretty clear based on this indication, on these stats from the Bureau of Labor Statistics. Next chart, please. So here we take a look at the jobs picture as they have impacted this leisure and hospitality space. Now, the left side of this chart shows the jobs picture, non-farm payroll by sector for March and April. Those are the 2 months where the COVID-19 really took hold. And we saw aggregate job losses for March and April combined. And then on the right chart, you see for May and June, when there seems to be a snapback in non-farm payroll aggregate by sector. So for March and April, the total job losses were 22 million, right? And you can see that leisure and hospitality had the bulk of those losses, 8.3 million. That's the blue bar right there, which equates to about 38% of the job losses in the US economy for those 2 months were accounted by the leisure and hospitality. Now, on the right side, for May and June, you notice that there's been a snapback, and you'll see that the snapback really reflects the impact of the leisure and hospitality group, accounting for a significant part of the job gains for May and June. Again, the one thing that we want to emphasize here is that some of the recent gains have tended to reflect the impact of the Paycheck Protection Program. And we think that, while the PPP program has been recently extended, it remains to be seen whether some of these job gains might be sustainable. So we would hesitate to extrapolate right now based on these data points that the leisure and hospitality will be able to sustain these gains. Remains to be seen what happens whether a lot of these furloughed or laid off workers would be permanently reinstated. That's something that obviously will influence the outlook for the recovery. The next chart, please. So here we're going to take a look quickly at some of the key metrics for the various industries that affect the outlook. In this case, restaurants, which we think are still facing an uphill task. One of the things we look at for restaurants, same-store sales and customer traffic, as indicated on the chart on the left. You see that there's been a steep fall off in same-store sales and customer traffic across the restaurant industry with the onset of COVID-19, down 55% in April, down a little bit more moderately, 40-something% in May. So I think that kind of underscores the impact of COVID-19. Nothing not quite unprecedented and nothing of the scale that we ever have seen. And again, even during the Great Recession, the numbers were nowhere near as dramatic. So this is something that I would also emphasize across the restaurant industry. It varies quite significantly. And while we've seen some of the restaurants that are exposed to fine dining and sit down and eating get hit harder, some of the other like quick service and pizza category tend to have actually benefited from some tailwind. So that's kind of a divergent. For the most part, the industry has suffered significantly, but there are divergences depending on the restaurant segment and the individual company and the digital capabilities, things of that nature. On the right side, we look at seated diners based on open table reservations. Pretty clear that with the onset of COVID-19, seated diners pretty much ground to a halt. And while we've seen some some return in recent weeks, it remains to be seen whether some of these metrics are sustainable, especially given we'll talk about the flare-ups and the walk back of some of the reopenings across some of the states. This is a metric that obviously will impact the outlook for the restaurant space, as a lot of them have now pivoted to off-premise sales, things like takeout, carry out, and curbside pickup and things of that nature, as opposed to seated dining. So dining room closures, for the most part, something that we're keeping an eye on to the extent that is something that has dramatically impacted the sales outlook for the industry. So moving on to the next chart, hotels and hospitality, based on some of the key metrics here. RevPAR, revenue per available room, occupancy, and average daily rate. You'll see that with the onset of COVID-19, these numbers really hit a bottom. Now more recently showing signs of some recovery, but still way off their normalized levels. So as we kind of think about the hotel industry, you'll see that these metrics are still tracking all-time lows. And as reopenings bode well, on the right side of this chart, the hotel supply and demand kind of seems like the outlook right now is for a snapback, and we think there's pent-up demand out there that could impact the recovery outlook for 2021. But right now, it's pretty clear that COVID-19 has caused a major supply-demand imbalance in the hotel industry, which will take some time to resolve. And that's really borne out by the outlook that we see for some of the key metrics. Moving on to the next chart here. This is casinos and gaming, where we think caution is very much warranted. A lot of the US casinos having significant exposure in Las Vegas and Macau still face very difficult challenges in what is likely to be a very slow recovery. On the left chart, you'll see visitor arrivals, some of the key metrics in both Las Vegas and Macau. And by the way, Macau is the Chinese province where most of the US casinos have significant exposure. In some cases, generate about 2/3 of their or more of their consolidated operating cash flow. So visitor arrivals in both Macau and Las Vegas in recent months looking like they've literally fell off a cliff. And as you see, from the chart, even most recently, just barely treading sideways. And I would say that the road for recovery for both in both Macau and Las Vegas promises to be very, very slow, arguably painful in some respects. Macau has been reopening, gradually, but there's still very strict protocols. Visitation is still, pretty tight. So things are not looking anywhere close to normal. In Las Vegas, I think there's just recently been talk about reopening some of the casinos, even on very, very limited capacity. So this is something that the casinos are confronting right now. Convention business has literally, ground to a halt. There's no demand for conferences and things of that nature. So that's something that has been having a major, major impact on the casino. On the right side, you see Macau gaming revenues on the chart showing a major, fall off down as much as 93% in the most recent reported number from May. So this is again showing that the casinos have a very, very tough hill to climb, and one that suggests that the outlook and the recovery path could potentially take years to get anywhere close to back to where the industry was. And a lot depends again on the easing of travel restrictions and all of those parameters that we talked about earlier. Next slide, please. And then cruise lines here. Cruise lines have been arguably the single most negatively affected industry by this COVID-19. As we sit here today, there's still a global suspension of cruise operations that started in mid-March that has been pushed back several times, and there's still no word on when things might return to normal. The CDC still has a no-sail order for the cruise travel, and so the cruise lines are still hobbled by suspension of their global operations. And as we kind of think about the outlook here, there's no question there could be some pent-up demand as travel restrictions begin to ease. But right now, the problems for the cruise lines are compounded by things like even the balance sheet and the having to navigate financial and liquidity issues. And on the right side, you'll see the exposure of cruise to cruise passengers by region, underscoring that the COVID outbreak across several regions, as you saw from that chart at the outset, has really had a negative impact on this industry. And that's why I think you see a lot of the volatility that we talked about earlier. So at this point, with that, I will like to turn over this presentation to Todd, who will now tie it all together for us with some really great insights on the ETF space that plays to some of the themes that we just talked about. Todd.
Thanks, Tuna. Let's go back a slide just so everybody can see the stock recommendations, because I'm going to reference some of those within my presentation. This is from our equity research team. We can move to the next slide now as I kick off to just set the stage for the ETF part of the conversation. We're going to review the first half of the year and then set a bit of the conversation towards what we're looking for in the second half. Let's move to the next slide here to just give you a lay of the land. The ETF industry is now over $4 trillion in U.S. assets. This is U.S. listed ETFs. It dipped below $4 trillion as we emerged into a bear market in March and before popping back up. That's both the returns of the securities inside as well as investor demand. You can see 3/4 of the assets are in equity ETFs, with roughly 20% in fixed income and much smaller slices in commodities and other. But on the next slide, you'll see that of the $200 billion that went into ETFs in the first half of the year, it was disproportionate. We saw nearly half of the money go into fixed income ETFs, a healthy weighting within commodities, and equities were there was demand for it, but not to the same degree that their asset base is representative. So fixed income and commodity ETFs really punching above their weight. On this next slide here, we'll just drill a little bit level lower. This is using CFRA'S own First Bridge ETF data. Ken touched on the acquisition we made in 2019, and it's really exciting to be able to dig closer into this. You can see within fixed income, the corporate bond space was extremely popular. The Federal Reserve began buying fixed income ETFs in May. They actually announced they were going to do so in late March, and that set the stage for investor support and interest within corporate bond ETFs. But we also have seen it outside of that, and we actually wrote a piece this week looking at insurance company demand for corporate bond ETFs taking place before the Fed made its announcement. Broad at U.S. equities, these are products like Vanguard 500 ETF, VOO, which was the most popular of the ETFs, GLD, and other gold-related ETFs pulled in about $25 billion. We're going to focus more on the U.S. industry and sector ETFs in upcoming slides, because to piggyback onto Tuna's work about the consumer discretionary space. But 18% of, $18 billion of money. That's actually more than our overall market share. And we saw, as we'll see on the next slide here, a range of different products that were popular. Healthcare and technology were two of the stronger performing sectors. So it's no surprise that XLV, a State Street product, and VGT, a Vanguard product, were the two more popular of these sector suite offerings in terms of investor demand. But interestingly, out of favor sectors, energy and utilities through XLE and XLU were extremely popular. XLE saw, the energy space recovered somewhat in the second quarter, but we saw buying taking place within the first quarter also, investors looking to bottom fish. XLU is, the utility sector is supposed to be defensive. This time it wasn't, it didn't hold up as well, but investors rotated towards this product and in particular utilities in a safe haven. Let's move to the next slide here just before I go into specific ETF recommendations and commentary. For those of you that are not familiar with our ETF and also our mutual fund research methodology, this is a good snapshot of it. We combine CFRA'S forensic and fundamental equity research that Ken talked about earlier to provide a holding space, forward-looking approach to rating equity ETFs. We separately rate fixed income ETFs differently, looking at the underlying holdings. We're not going to focus on that now. But to us, what's inside the portfolio is significant. It's a key driver of results. But we do take into account the fund's performance record and cost structure as we're looking for ETFs that are going to outperform over the next 9 months. So on my next two slides, we'll move to the next one first. I want to cover two different ways tied to the themes that Tuna talked about. So XLY is a consumer discretionary select sector spider. This is the largest of those consumer discretionary ETFs, while we have iShares and Vanguard offering products as well. The sector spider XLY is by far the biggest. It also was extremely unpopular. More than $1 billion of outflows took place in the first half of 2020. Investors had concerns for some of the reasons that Tuna talked about the state of the consumer. Despite the fact that the largest constituent and the largest industry is internet and marketing retail, and Amazon being the heavyweight within that group, and obviously you listening as well as my family is constantly using Amazon to get deliveries. You can see the breakdown in some of the other industries. Hotel, restaurants, and leisure is the third largest of those industries at roughly 20% of the overall pie. And this ETF holds McDonald's and Starbucks in addition to Amazon, Home Depot, and Lowe's. This earns a 4-star rating based on its reward and cost attributes from CFRA. On the next slide, I just want to show you in part another way to play this space, one that investors have been putting money into. But we at CFRA independently have concerns about. This is PEJ. This is Invesco's Dynamic Leisure and Entertainment ETF. It's a much smaller ETF, 250 million. Easy to ask, why are we talking about it? Well, it's gathered over 200 million, in part because this is a way to play a potential recovery within the leisure space. A number of these restaurants that you'll see listed among the top 10 holdings on the slide here. But we have concerns about the risk characteristics and also the expense ratio of 63 basis points. So while this is certainly getting investor interest, we think there's better options within not only the consumer space, within the broader sector lineup. And with that, Ken, I'll pause here. We'll move to the next slide. I believe this is where you'll take some questions that we have from the audience.
Thanks, Todd. And we do have time, so please submit your questions. Sam, one that we've gotten, and the backdrop is the S&P 500 is near its all-time highs. And why has Wall Street been ignoring the recent uptick in COVID-19 cases?
Well, Ken, that's a good reason, or a good question. I think basically Wall Street is saying that even though we've had an uptick in the coronavirus, that they don't expect a federally mandated shutdown. It's going to be taken on a state-by-state basis. Also, I think Wall Street is the general populace does not want to be shut down, and so it is pushing for at worst, do we go back to a yellow scenario rather than a red scenario once again? I also think that expectations are for a COVID vaccine to arrive fairly soon, and then that could allow everything to go back into the green zone. And then finally, looking at overseas, we're seeing that we don't have the increase in COVID cases that we do here in the US, and that in general, economic conditions combined with earnings forecasts continue to be fairly optimistic. So I think that's the reason that Wall Street is not bailing out of stocks. That said, I am a bit concerned because valuations are very stretched. We're trading at 25 times next 12-month earnings, which is a 50% premium to the average over the last 20 years. And unless we start to see a confirmation of our optimism, I think investors might decide, well, maybe I should be waiting until I actually get that confirmation before getting additionally excited.
Tuna, certainly industries that are in dire straits with COVID-19, whether it be leisure, tourism, hospitality, or restaurants. And what do you think can shape the influence of recovery, especially for 2021? And I saw a pretty optimistic chart there for the cruise industry being at a higher level than other years past.
Right, that's a great question, Ken. So I think as we think about the factors that could shape the recovery, I think a few come to mind. The travel restrictions right now just seem like it's a moving target, and also the development of vaccines or effective therapeutics. These are all things that will make the consumer more willing to travel, whether it's air travel or cruise or whatever it is. And these are all kind of things that are right now very fluid as we think about the sentiment, the financial condition. These companies, I think it's fair to say that we've taken a much closer look at their liquidity and balance sheet. Some of them are more highly leveraged than others. For example, the cruise lines have been navigating some pretty difficult liquidity challenges. Most of the companies in this space, I might add, have they've taken a number of actions to conserve their liquidity and shore up their financial position, things like dividend and capex suspension or reduction, share buyback suspension, and going back to the debt market and tapping into their revolvers. So for the most part, I think what COVID-19 has done has made us a lot more vigilant on the balance sheet and the financial situation. I'd say the cruise lines probably are the most exposed right now from a balance sheet perspective. And then within the restaurants, you've got others as well that have relatively high debt. And so that's something that, as we think about the recovery outlook, we don't think that, we think there is going to be some shakeout for sure. And not every company that entered into this pandemic will make it out in good shape. And we've already seen some companies that have been talk about potential bankruptcy. And I'd also point out that S&P has done some work that we have been looking at in terms of the exposure on the credit side and potential impact across publicly traded companies. So those are things that I think are all factors that will dramatically reshape the industry as we kind of look to the other side.
Tim, a quick question on your slides when you were talking about job losses. The question was, were these U.S. only or were they worldwide?
They're U.S. only. They're U.S. non-farm payroll, as we know. The U.S. non-farm payroll for what was down significantly in March and April, rebounded in May and June. Yeah.
Okay. Todd, investing in ETFs, whether it's the constituents or looking at flows, VGT has strongest ETF inflows, and it's possibly more popular than its peer XLK. What's the profile and what should investors think about this?
So VGT is Vanguard's Information Technology ETF. XLK is the State Street product, the Technology Select Sector Spider. The Select Sector Spiders offered by State Street typically are the largest of these sector suite of products. They're tied to the S&P 500. They've been around a long time. They're highly liquid and they appeal often to a more tactical audience. So we were encouraged and actually a bit surprised to see that VGT is now even bigger. It has a lower expense ratio. VGT is just 10 basis points, so a handful of basis points lower than XLK. It offers a bit of the small and mid-cap exposure, but it's still heavily concentrated in Microsoft and Apple and Visa and other large-cap technology companies. I think it's just a sign that more of a wealth management audience is using tactical ETFs like sector products. The fact that Vanguard's product overtook what we saw from State Street. It's the only of those peer-to-peer products that Vanguard is the leader of the traditional sectors.
Sam, great slides, you know, given with the upcoming election and looking to history on composition with the Democrats and Republicans. But I kind of like this question. You know, given socialistic position of Dems and focus on shutting down businesses that might use carbons, could this time either be different or more extreme than when Adlai Stevenson was running against President Eisenhower in 1956? That's my ad.
Yeah, well, no, you're absolutely right. That is a very good question because usually it was that you had both parties be center of the road, middle of the road, and whichever parties seemed to be a little more centrist. And also, if you did not have one party exhaustion, then that party got elected. But it seems as if now both parties are at extremes. And so I think what worrying Wall Street is that Joe Biden will probably end up having to bow to the extreme liberal side of the Democratic ticket and embrace many seemingly socialist actions, agendas, et cetera, which really could increase the tax rate, could undo many of the lessening of regulations, et cetera. And so I think it's, you know, investors are basically working themselves up into a frenzy as to what could actually happen should the Democrats take control of both the White House and Congress. So no election is exactly the same as any other election. History, I always say, is a good guide, but it's never gospel. And it could be very different this time than it was in the past.
Great. One quick question here, Sam, on the chart with the Democratic trifecta. Was that the returns for the S&P 500?
Yes, those were price returns for the S&P 500 during those 5 observations.
We're coming up on the hour, so I'm going to go rapid fire for 2 or 3 minutes. Sam, you referenced worst to first strategy. Again, what is it? And maybe link that to what sectors do you like for the second half of this year?
Well, worst to first strategy basically says whatever was the worst during the market decline, because investors price these sectors, sub-industries as if they were going out of business. If they did not, well, then these are the ones that tend to bounce the most. So energy, financials, industrials were the ones taken on the chin. Energy, consumer discretionary from a sub-industry perspective were the ones that were beaten up the most, but also bounced quite significantly through June 8th. I think Tuna articulated very, very well that we have to be careful that a lot of the enthusiasm jumped right back into that vacuum of valuations for the consumer discretionary group, and it's going to be a lot more challenging going forward. History says the May through October period in general and the third quarter specifically are very challenging to stocks. So we currently have overweight recommendations on technology because of low interest rates, good earnings growth expectations and momentum, healthcare because of the defensive characteristics, and the strive toward coming up with a COVID vaccine, but also communication services because of their slightly defensive characteristics. So probably a challenging few months ahead with increased volatility.
Tuna, you did a great job prosecuting the current state for industries. And if you're an investor looking out to 2021, which one or two of the four do you think would have the greatest chance for recovery into 2021?
I would say, the restaurants, and within the restaurants, I think I would be very selective for. I would lean toward the restaurants, the quick service, and the pizza categories that have actually seen their same-store sales and customers traffic increase at the expense of the rest of them. Names like, for example, McDonald's, which is still down, but relatively speaking, outperforming the broader restaurant space that has been hit hard by the closure of dining rooms, and names that are skewed toward sitting, eating, dining, casual dining have been underperforming. Name like, for example, Chipotle, which we hold based on valuation, has capitalized tremendously on digital ordering. So third-party delivery, things of that nature. Off-premise has really been a major theme within that. So that's one area that we would say have actually benefited from some tailwinds. And also, liquidity issues are less prevalent within that segment of the restaurant industry. Other than that, I'd also say, Ken, that there's an asset-light theme, asset-light strategy. Some of the hotels and restaurants have been shifting toward from ownership to franchising, minimizing their capital exposure, and that's something I think that will serve them well within this COVID environment. McDonald's comes to mind as well in that strategy. Young brands that we hold. Some of the hotels have also been shifting toward that, but for the most part, I think as you know, valuation is something that determines a lot of our stars recommendation, and given the volatility that we've seen within this overall space, we have tended to lean a little bit more on the neutral and cautious side with the uncertainties around the lifting of travel restrictions.
Okay, great. And by the way, Tuna is profiled with a video on the CFRA website on restaurants. Todd, last one for you. And Todd is regularly appearing on CFRA webinars. Looking to the second half of the year, just give us some bullets of what are the key ETF trends you're watching.
One of the major trends we've seen in the first half of the year has been launches of actively managed ETFs. We have not seen the money flow in yet, but we have seen brand name firms like Fidelity, like ClearBridge, which is part of like Mason right now, as well as American Century. T. Rowe Price announced this week that they were going to be taking the next steps to launch their own active equity ETFs. So I think that's a space to watch, maybe not to move money into initially, wait till you understand it, understand what's inside it. But that's something from an industry perspective we're keeping our eye on. And fixed income ETF demand, which I touched on, is more than 40% of the overall share of inflows and roughly 20% of the ETF pie. We think adoption is going to continue at this rate in the second half of the year. As long as interest rates are low, investors are going to look to save fees to be able to do that. We didn't touch on fixed income in depth, but CFRA's coverage of fixed income ETFs is expansive, and I think there's lots of great choices. So those are two key themes we're focused on for the second half of the year.
Great. I want to thank all our presenters. Cassie, if we can go to the last slide. Great. So first of all, I want to give recognition to the CFRA marketing team for putting together the webinar series. What we have done is try to reach broad investment themes, finishing in June with the impact of COVID-19. We've moved to the next campaign for August and September, the road to recovery. And of course, right after that, and you had from Sam, is the election. But August and September, you can see here, we're giving CFRA webinars addressing certain questions about recovery for industries related to the disruptive technologies, a big profile on cloud computing, August 12th. August 26th, fascinating insights in terms of where we are in terms of COVID-19 therapies. Actually today, Kevin Wang launched coverage of Moderna, and you can see his in-depth report on MarketScope Advisor, and then of course outpatient recovery for the medical landscape. We then move to American infrastructure, the opportunities, risk, and politics, whether we have both parties reach across the aisle for legislation or not, but infrastructure is important. And then we have real estate, road to recovery from the abyss. So that's our next campaign. We hope you're with us and you're getting invites for each of these four. Obviously, you can always get more about CFRA in our research, whether it's the webinars you see on the lower left, and certainly to take advantage of MarketScope Advisor by going to the site mentioned at the bottom. Most important, stay healthy and safe, and enjoy the rest of your summer. Thank you for joining us.